how he's actually investing in 2023. I mean, he's tweeted here and there about cash flow and debt buybacks, but what if I told you I found a much more detailed view of his strategy this year? Well, technically I didn't find it, Investing with Tom sent it to me, but the point is, I got my hands on Burry's investor letters from 2000 and 2001. And before you ask, what the hell does that have to do with his strategy today? Well, Michael Burry recently has been talking a lot about how the current market looks very similar to the mid to late 2000s. So we can actually dive into these letters to get a really clear perspective of what Burry thinks is going to happen in the markets and how he's navigating them. Most people know Michael Burry as the protagonist in Paramount Pictures' The Big Short, which is a movie about the true events that led to the global financial crisis in 2008. Michael Burry, the main character played by Christian Bale, is a fund manager who discovers some severe instabilities in the US housing market before it collapsed and almost destroyed the entire financial system. The movie is called The Big Short because Michael Burry allocated a huge amount of his investment fund's capital to betting against mortgage-backed securities that ultimately crumbled from widespread defaults. But before all of this even happened, Michael Burry was already a very successful value investor, and for years he's been laying out his investment strategy in quarterly letters to clients of his fund, Scion Capital. And there's actually a lot that the average investor can learn from how Michael Burry was investing in 2000 and 2001. During those years, his fund made a return of 68.24%, while the S&P 500 actually declined a total of 18.45%. So Burry's strategy during this time not only allowed him to avoid the prolonged decline that the broader market faced, but also to actually perform extremely well during this difficult period. And more interestingly, Burry actually thinks today's market looks very similar to what it did back then. So before I break down Michael Burry's investment strategy, I want to talk about why Michael Burry thinks that today's market looks similar to the early 2000s. Much like what we saw play out in late 2021, in the year 2000, highly speculative and unprofitable companies saw significant declines in their stock prices, which we now know as the internet bubble. But not a lot of people talk about what happened next. While speculative internet stocks collapsed severely, as should be expected, it wasn't until late 2000, almost a year later, where the rest of the market began to fall, and then in 2001 a recession began, and the broader market actually didn't reach a bottom until 2003. And Burry sees a similar story playing out today. In late 2021, speculative and unprofitable stocks started to crumble, with many of them now down 80% or more, and a few months later the rest of the market began to fall. In a tweet from a few months ago, Burry said that he thinks today's market looks like the mid to late 2000s period, which essentially means he believes that the broader market has further to fall. And this isn't Burry just looking back in hindsight, because he actually had the same contention before this had happened the previous time in 2001. He wrote that his preference is to buy long-term franchises at a substantial discount to growing intrinsic value, or in other words, to buy high-quality businesses. But that as of early 2001, high-quality stocks still had high valuations based on overly rosy future expectations, and that they would be prone to further revisions as expectations were reined in. And he was exactly right. From that point forward, the S&P 500 fell another 25% over the following 2 years. Today, the biggest names in the S&P 500 still have prices that arguably reflect very rosy future expectations, and if there was to be a recession, say at the end of this year or throughout this year, similar to the recession that came after the tech bubble in 2001, then it wouldn't be surprising to see large companies have their expectations reined in, similar to the large cap businesses in 2001, and that maybe they have more to fall. So how did Burry make almost 70% over 2 years while the rest of the market was declining? Well, he certainly didn't do it by buying expensive large cap companies that still had a ways to fall. Instead, he was looking for undervalued, often very small and illiquid securities. These are groups of stocks that fall under the traditional definition of value. And it looks like this group of stocks are in a similarly good position today as well. Unlike large caps, which prior to 2022 have just been going up at massive rates, traditional value stocks haven't seen that same run up. Although in the last year, in 2022, as the market has collapsed, those value stocks have also experienced the downside. And the result of that is there is now a very large spread between the valuation of value or cheap stocks and the rest of the market. I spoke about Joel Greenblatt's research on this in a recent video. His research showed that the US market is still around the 22nd percentile towards expensive, while value stocks are near the 90th percentile towards cheap. And that research supports Michael Burry's contention that similar to the early 2000s, we may be about to see value stocks do far better than the broader market. Again, in a tweet from a few months ago, Burry said, free cash flow totally on sale, better businesses still had a way to fall, value was about to take off for years despite more crash on the way. Given that Burry sees today's market very similarly to the early 2000s, it seems appropriate to learn how Burry was investing in the early 2000s. And while I've mostly avoided learning about Michael Burry's investment strategy, which more recently has come to include a lot of macroeconomic predictions, his strategy in the early 2000s is very much classic value investing that is very likely based on the teachings of Benjamin Graham. And since we have access to his quarterly fund letters, we can see exactly how he was investing back then. The biggest common thread throughout the 8 or so letters that he wrote between 2000 and 2002 is the difference between volatility and risk. Burry operates very differently to the vast sea of average performing institutional investors, and one of the main reasons he's able to outperform them is because unlike them, he doesn't consider volatility a risk in investing. In one of his letters he writes, "By and large, the wealthiest of the wealthy and their representatives have accepted that most managers are average, and the better ones are able to achieve average results while exhibiting below average volatility. By this logic, however, a dollar selling for 50 cents one day, 60 cents the next day, and 40 cents the next day somehow becomes worth less than a dollar for selling 50 cents on all 3 days. Of course, to any rational human, this is absolutely ridiculous. The value of a business doesn't change based on the changes in what investors are willing to pay for it. And Burry demonstrated this idea in Q4 of 2021 when the September 11 terrorist attacks drove some stocks to absurdly low prices. One of his positions fell to a price that was 3/4 of the free cash flow it produced in the last 12 months. Burry bought more of this stock during this time, and in less than a month, it had 3x'd from the value that it had fallen to during September. And the next month, in December, it was acquired for 7 times its September price. And this is a fantastic demonstration of what most fund managers get wrong. This stock in Burry's portfolio absolutely increased the volatility of his portfolio, but it didn't increase the risk. Whereas most fund managers would have ignored this investment simply because of the volatility, thinking that the volatility made it a bad investment, even though objectively you could have looked at the price relative to the cash flows and the business behind it, and it made absolutely no sense to not invest in that company. Burry also gives a number of insights into how he structured his portfolio back in the 2000s. He ran a relatively concentrated portfolio of 15 to 25 stocks or less, noting in one letter that diversification doesn't require more than 15 or more stocks if done correctly. Burry says that he structures his portfolio to protect against a wide variety of unforeseen circumstances. And in his mind, the best way to do this is to minimize correlation between stocks in the portfolio, such as investing in different industries.